Hi, good morning. I'm Kay Gotshall. We're going to talk about state and local updates. Here's our beautiful pictures. I'm Kay Gotshall. I'm a tax senior manager here at Hyder. Thank you for joining us this morning. Okay, I did not click that. And Terry, why don't you introduce yourself?
Hi, I'm Terry Barrett. I'm a tax senior manager at Hyder as well, focusing primarily on consulting on indirect tax issues. Go ahead, Kay.
So brief reminder, remember you need to still do the 3 out of the 4 code words, and we will try to make sure we actually call out the code words. So hopefully that'll remind you guys to go ahead and put in the code words. Make sure you exit a full screen if you're on full screen. And then if you have any questions, make sure to go ahead and put them in the Q&A section in the right of your screen. So, you know, we welcome questions. Some of the stuff we're going to go over. If you need more clarification, or if you want to touch base with us after the presentation, you can let us know if you have any questions then too. So learning objectives, understand the recent developments and SALT, state and local tax, recognize potential issues that may influence income and sales tax filing requirements, identify possible tax filing requirements due to remote employees. So we'll talk about COVID and telecommuting, and then being aware of key SALT items for year-end planning and what you want to look at. So here's our agenda. We're going to go over basically 6 topics: economic nexus and Wayfair, Terry's favorite topic, pass-through entity taxes. These are the taxes that Vince alluded to earlier, trying to circumvent that $10,000 SALT limitations. We're going to talk a little bit about selling taxable services. So this is software as a service and digital products, sourcing of income for services for income tax purposes, basically market-based sourcing, COVID effects on telecommuting, and then year-end SALT planning considerations. So Terry's going to kick it off with Nexus and sales and use tax.
Well, the hottest topic today in the state and local tax world still is economic nexus as it relates to sales and use tax as well as income tax. Back in 2018, the Supreme Court ruled in the Wayfair case, and it was primarily a sales tax case, but it has really changed the whole world, or whole United States taxation as it relates to income and sales tax. So for sales tax purposes, traditionally, physical presence equates to a sales tax collection requirement. We all know that. You got physical presence in a state, you have a tax collection requirement to the extent you are selling taxable sales. However, with Wayfair, now you potentially have other tax requirements, and it specifically said the states may require remote sellers, and this isn't just internet sellers. I want to emphasize that it's not just internet sellers. You know, to the extent that you have sales in other states or customers in other states, you potentially have state sales and use tax requirements. And so what it means is that businesses that sell taxable products and services to customers outside their home state, and so outside Virginia, you might have a sales tax collection requirement if you meet the other states' threshold requirements. And this includes many of you. I mean, you have to think about, well, in Virginia, a lot of services aren't taxed, but other states tax services. So you don't have to think, you have to kind of expand your knowledge. It's not just Virginia now, it's other states. You know, what might Wyoming or California or Indiana or these other various states tax? And if you have customers in those states, potentially you have sales tax collection requirements. And with this chart or this map, you know, we've used this map forever. You know, ever since I've been with Hyder, we've had a map of the states as far as economic nexus. But essentially now all states require sales tax collection, you know, to the extent that you have or you meet the threshold requirements in the individual states. And you can see the purple states are the states that don't have a state level sales tax. The orange states are the states that do have sales tax requirements for online or remote sellers. And then the white states, Missouri and Florida are the two kind of the stragglers in the remote sales tax world, where they have only recently passed legislation to require sales tax collection for sales in those states. And you have to keep in mind too that the state threshold requirements are a little bit different. So most states say if you have $100,000 in sales or 200 separate transactions, then you have a tax collection requirement in that state, assuming of course that you have taxable sales. But again, you can't think about Virginia only, you have to think about other states and research those other states, threshold requirements to determine, yes, potentially I might have a tax collection requirement in other states. So that's just something to point out that Missouri is lagging a little behind. They're not, their rule isn't effective until 2023, but Florida is already on board. So essentially, if you're selling in pretty much any state, you need to look at where your customers are, what you're selling, is it taxable, what are the state thresholds, and should I be collecting sales tax? Because at the end of the day, yes, the states will find you and they will come after you. Not to be doomsday person, but that's kind of my job at Kiter. I tell everybody, oh, you've got a tax collection requirement. So anyway, from an income tax perspective, before Wayfair, a lot of states had already adopted economic nexus for income tax purposes. But with Wayfair's assertion or the Supreme Court's ruling in Wayfair for sales tax, a lot of states feel emboldened now with regard to income tax nexus. And so a majority of states do have economic nexus for income tax purposes. They have kind of essentially two different approaches. One is they have bright line thresholds, which is great because you know when you're subject to the tax in the state, or they have a kind of willy-nilly deriving receipts, transacting business, doing business in the state, in which case you're going, am I really doing business in the state or what am I doing? Am I subject to the individual state's requirements? But in this chart, we've included the states that have a bright line test, which is great. Again, you know if you hit that bogey, you are subject to potential income tax requirements. And I want to point out too, one of the new states that's been added is Maine. But theirs is not effective until, was it 2023? But again, you need to be aware of the individual state requirements when it comes to not only sales tax, but income tax from an economic nexus. Yes.
For the states that have all three in that chart, do you have to hit all three or just one?
You just have to hit one. You have to hit one for this, that's a good question. Question was if you have a state that has something in each of those boxes, do you have to hit all three or a single requirement? And the states generally say that if you hit either one of those, the sales, the payroll, or the property, or, as we've got a little footnote at the bottom, to the extent that you have 25% of your total sales, property or payroll, or in that state, you have potentially an income tax filing requirement in the states. And I do want to point out too, with respect to Hawaii and Washington State, because their thresholds are so low, it's $100,000 in sales. And what they did, both those two states, is that they made their income tax requirements the same as their sales tax requirements, which makes it easier, from a compliance perspective, but it also makes it more difficult if you are a taxpayer trying to comply. If your sales are really only $100,000, that's not so much. So anyway, just wanted to point out these thresholds. And again, if the state doesn't have a threshold, we don't have an issue. Yes.
So with remote workers and having a lot of people outside of maybe your main state, this seems like a lot of extra work for the HR payroll people to track where they are. Is there any advice on what to do if you have somebody that wants to work in Florida for 6 months, or but it's not nice here?
Yeah, and the question was, and I don't know if everybody heard it, was if essentially if you have sales in these states and payroll in these states, are we with telework now these days, do we have additional tax reporting requirements. And we're actually going to talk about that in a little bit. So just hold tight on that issue. But just to point out that these are potential requirements in the state or tax filing requirements. But also wanted to point out that Public Law 86272, which is a federal law, it prohibits a state from imposing an income tax. And I want to stress income tax on an out-of-state business when soliciting sales of tangible personal property in the state when the orders are approved and shipped from outside the state. So to stress and point this out, it does not apply to franchise, gross receipts, or other kind of quasi-income taxes that the states might impose, like the Ohio CAT or the Washington D&O tax. So it's very limited to income taxes. It does not apply to sales of services, which we are finding that people are getting into sales of services more these days. Also, it does not apply if unprotected activities occur in the state, which I'll talk about in a minute, but we need to be aware of the specific state requirements, because even if you meet the public law protections, yes?
We have a question.
Yes.
It says what states, what states most actively impose sales tax on services?
Okay, the question is what states most actively impose sales tax on services? Good question. I mean, there are some states that have a greater propensity to tax services: Hawaii, New Mexico, South Dakota, Connecticut, New York, West Virginia.
Those are the main ones.
They're
I
the
think
main
you
ones.
talked about.
Yeah,
Go ahead.
and Texas too. But yeah, there are a number of states, but what you need to do is consider what you're actually doing and the state, and then kind of look into the state requirements, because it can vary by state.
And you may have a sale of a product that you think is not necessarily a service, such as software as a service, or you're selling some type of licensing of software. And that, though, anything to do electronically or over the internet, you really need to look at the details. I know Terry has taught me this over the years. That it can be data management, and you may not think it's necessarily a service. You may be thinking you're dealing with software, and that's and it can throw into a taxable service. So even though it may be only 5 to 6 states tax quote unquote services, if you encompass digital items now, digital marketing, digital advertising, anything to do with software, databases, that can be seen as a taxable service. And can be taxable in even a greater number of states. Is that a good way to summarize it, Terry?
Yeah, that's a great way, Kay. And we're going to talk about that a little bit more as we progress through the presentation. But yeah, potentially that is an issue in a number of states. You have to not only know what you need to understand what service you're providing and the underlying factors of it as well from a sales tax perspective. But just going back real quick on an income tax perspective, you need to be aware of the state requirements. Just because you might be exempt from an income tax payment in a given state, you might not be exempt from the state's filing requirements. And currently some states take the position that even if no tax is due, you still need to file. Okay, for example, Pennsylvania has an economic nexus threshold of $500,000, began in 2020, but you still need to file, even if you hit that threshold. And there are certain forms that need to be filed, and you're going, why do I need to pay Kiter to file those returns for me? But the state says you do, so you should comply with those requirements. Also, with Tennessee, economic nexus threshold of $500,000, public law protections apply to the excise tax, but not to the franchise tax. So you have to be aware that if a state has both types of taxes, you potentially have a filing requirement. And then Texas is very challenging for everybody, but they have an economic nexus threshold of $500,000 in sales. So, no physical presence, just sales into Texas. The public law protections do not apply to Texas. So if you have $500,000 in sales in Texas, you should be filing the franchise tax, and you should be paying sales tax to the extent you are selling taxable goods in the state. Our first code word for our session is 4:30. Just follow the same kind of process that you did with Vince's earlier session. So it's 4:30. And we just wanted to point out quickly about the Multi-State Tax Commission. You know, we've talked about Public Law 86-272, where you've got the protections. If you're soliciting sales of tangible personal property in a state, you don't have nexus and necessarily a tax collection or filing requirement. But recently, the Multi-State Tax Commission came out with a revised statement because why? You know, the world is changing. You know, the way we do business is changing. And their revised statement takes the position that, you know, taxpayers that engage in internet activities, they make sales through the internet, they potentially might be exceeding the public law protections in a state. And so we've listed on this slide different activities that might constitute doing business in a state by placing cookies on in-state computers that are not ancillary to the sale of tangible personal property. You know, if you're posting jobs on your website and people can respond, that might exceed the public law protections. If you're doing video streaming or music streaming or something like that, if you're providing an opportunity to download software via your website, that too will exceed the public law protections. And so just as a cautionary note, not all states, or few states have formally adopted this new guidance, but it's out there. And, you know, a state might say, well, we don't have to formally adopt it. It's out there and we're going with this anyway. So it's just to be aware of these potential issues to the extent that your activity in a state exceeds the mere solicitation of sales. And also, just want to point out one last thing. They said for Public Law 86-272 protection purposes, that if you have someone who telecommutes on a regular basis, which a lot of companies now do, you know, from within a state, that potentially creates income tax nexus. So unless, of course, they're only soliciting sales of tangible personal property, and that's really a very limited situation.
Okay, pass-through entity taxes. Very fun stuff. So as Vince alluded to back several years ago in 2017, the end of 2017, TCJA was passed and limited state and local taxes deduction at an individual level to $10,000. So the state started to try and pass their own laws to help alleviate on businesses. I mean, it's really kind of unfair to individuals who own businesses through pass-through entities such as an S Corp or an LLC to, you know, not allow them to deduct the business taxes associated with that business income. So states started passing laws, and it really started out with Connecticut. And this is a current map of the different states that have passed these laws. And as you can see, we've got some detail on the next two slides, but let me point out a few things. You know, Connecticut kicked it off back in 2018, and they're one of the few mandatory, that's what the M stands for after Connecticut, one of the few mandatory states that have this pass-through entity tax. And as I said, starting 2018, some states tried to say that if you made a quote unquote charitable contribution to the state, you could get a credit. The IRS came out very quickly after that was introduced by a few states and said that's not going to work. At the end of 2020, IRS came out with a notice 2020-75 that basically said, if you have this type of a tax in Connecticut, like Connecticut had passed, then you will get the deduction. It is a valid deduction at the entity level. So that kind of confirmed. So after that was, you know, came through, a lot more states started to pass these tax laws. In fact, there were 5 that came out in 2019 that were kind of ahead of the IRS ruling. There was one that became effective in 2020, and I think really that had a lot to do with COVID and how much, was being passed during that year. But then it jumps up to 8 becoming effective in 2021. So you can see after the IRS passed that notice in 2020, a lot of states jumped on the bandwagon to try and pass this pass-through entity level tax. And then there were 4 more states that became effective, that'll become effective in 2022. So just a few things about these 2 slides. The E means that it's an elective. The M, as I said, is mandatory. So elections need to be made if you plan on, assessing or having this entity, pass-through entity, pay and collect the tax. So you can see here a wide variety of states have passed these. There are a lot of differences in the elections, how you make the elections, if they're permanent or not. So you definitely need to be evaluating this. This is something that you want to do. As Vince had noted, though, the $10,000 may be increased to $75,000, or $75,200, or $72,000. Sorry, $72,500. So whatever the final number is, it may be increased. So this may help alleviate some of these issues. So this might not be as big of a deal, but if you have, large amounts of business income, it is definitely something to consider. So since this is such a big and new item, I wanted to kind of go over a little bit more of how basically it works. So generally, the entity is going to file a state return. Anyways, normally an entity would file a state return anyways, pass all the income through. There might be some non-resident withholding that the entity would pay, but it's not necessarily an entity level tax. So in these states that have passed this tax law, they file an entity level state return and they pay the tax. This tax is not going to be a composite, and it's not going to be it's going to be for the non-residents. It's going to be for all the owners of the particular entity that's filing it. So it's not like a composite return that's an individual return on behalf of the non-residents. Also, as I said, that generally this tax is going to be paid. It's going to pass through on the Schedule K-1 as a credit to the owners. And then these non-resident owners, or actually all the owners, obviously the resident owners of the same state that if they're filing will have to file a return, but even the non-resident owners of that state will still file that state return and claim the credit that was paid at the entity level. So that's where where it comes in, where this credit that comes in. This tax that the entity pays, this deduction is going to be at the entity level. It's not going to be a distribution. Currently, if you have a payment at the entity level for a state tax on behalf of the non-resident, it's referred to as non-resident withholding. That generally will also flow through, but it's only on non-residents, and those particular taxes are shown as distributions, not as a state tax deduction. So there are some slight differences between non-resident withholding and this pass-through entity level tax. And then the last point, that the key is here, the owners may be able to claim. So if you're a non-resident of that state, owner of that entity, you may be able to claim the credit on your resident state return. So that way you're not double taxed, because as an individual, when that income passes through from that entity on your resident return, you get taxed on 100% of it. There's no apportionment factor at the individual level. You get generally, most states say you get a credit for taxes paid to other states. I put may in red because it's still kind of unknown, at least in the state of Virginia, if that's going to be allowable as a credit. We think it is, we believe it is. It kind of fits the description of what a credit should be, but there has been no confirmation from the state of Virginia that it would qualify as a credit, because the individual isn't really even paying the tax. It's coming through as a credit. So here's our 6th code word, 895. So make sure you're putting that in to the screen at the upper corner. And there it is again, 895. So there are several considerations. I have 2 slides of considerations when you're thinking about doing this. This is very new. As I said, 2020 was one of the first years that a lot of states actually had this credit. And this pass-through entity level tax, it's going to be even more in 2021. As I said, 8 states have enacted this and are being effective in 2021. You want to check on whether it's mandatory or elective. And if it is elective, is the election permanent or is it an annual election? And that's very key, because if it's a permanent, then essentially once you make that election, then you've made it a mandatory item. So, you definitely want to be looking at that. If it's, an annual election, you have to do it every year. These elections are due at different dates. Some of them are due within the first 2.5 months of the year. The state of New York, their new PTE was effective in 2021, and that election was due. It was passed in the middle of 21, the tax code was. And the first election to be elective to have it applied in 2021 was October 15th, 2021. We were very busy trying to get October 15th due date. And, we realized this and we're trying to reach out to our clients. So if you didn't make the election for New York by October 15th due date, you are not going to be able to do the pass-through entity for New York for 2021. You can turn around and do it by March 15th of 2022 for New York, but you're not going to be able to do it for 2021. So those are things that you want to watch out for. Yeah, Izzy, question.
Can a tiered partnership entity make different elections?
In a tiered, this is normally at an entity by entity level. And some states will require the tax to be withheld on all of the owners. There are other states, New York says you have to withhold the tax, or not withhold, but you have to pay the tax on all the income on all the entities. So whether it's a corporation, whether it's an LLC, there are other states such as Arizona. I was researching yesterday. Arizona has it, and you only pay the tax on the income that flows to trust estates and individuals. And it only can be those that have elected to be part of the pass-through entity tax. So it's very different for every state. So if you have tiered entities, yes, you could probably, depending on the state, you could possibly do it. As I said, there are some states such as Arizona where it doesn't really apply if you've got a tiered entity. So it's really going to be state by state specific, which unfortunately is the way it is with most multi-state items. It's very state specific. So when you're considering this, you look at the pass-through entity owners. As I said, some of them may be nonprofits, some of them may be non-taxable IRAs, some of them may be individuals, LLCs. Are they closely held? If you have a wide variety of owners, some being nonprofits, some being LLCs, some being individuals, it may be difficult because when you pay that entity level tax, I don't know how you're going to specially allocate. If you don't pay it on behalf of all of the members, that expense is going to get expensed to all of the owners. So I don't know how you would specially allocate state tax expense. So that's one definitely consideration. I see where it definitely helps when you have a closely held company as opposed to wide variety of owners. The other thing you want to look at, what is the rate of you're paying at the pass-through entity rate? I was looking again at 2 states yesterday for a client who's considering this, and usually the rate that is being paid at is the top individual rate. So if a state has graduated rates and you have a large number of owners that may possibly be taxed at the lower rates within a state, and then you're coming in and paying the tax at the entity level at the highest rate, there could definitely be some additional tax code. You can see where the states grabbed onto this because they're getting that tax up front. They're paying it at the highest individual rate. And if you do pay it at the highest individual rate, and that credit that passes through the owners, is that credit going to be refunded at the entity level? At the individual owner level, or is it not going to be refunded? I was looking at Arizona yesterday, and that credit that flows through is not refundable, and it can't be refunded, and it only gets carried forward for 5 years. So there are going to be different nuances. You definitely want to make sure you're doing your homework and your research, because there are slight differences and probably some major differences. I think that would be one of the major differences between the Arizona credit and versus another credit where the credit comes through just as a normal payment. It's like a withholding payment. and it is refundable. So definitely want to be checking that because the rates that normally are going to be paid at the pass-through entity rate is going to be the highest individual rate. They want their money. The other thing, it doesn't, this pass-through entity tax return that's being filed and paid, it doesn't alleviate the non-resident from filing an individual return. They still have to file an individual return at the individual level. And where a composite return, when I mentioned a composite return does, satisfy that filing requirement. So again, slight differences between the pass-through entity tax and a composite return. And another thing to consider is if you're an accrual basis taxpayer, you probably want to accrue, you should be accruing these entity level taxes at the end of the year. So you'll have almost like a mini income tax provision, because if you don't get that income tax accrued as accurately as possible, you could be allocating the expense to different owners. So if you have changes in ownership, from year to year, if you don't get it properly accrued at the end of the year or accurately accrued, you could be allocating it when you have a true up in the next year to different owners. Some other considerations, we talked about allowing the credit on the non-resident owner's return. As I said, the Virginia side of CPAs back in August of this year requested a letter ruling from Virginia. Maryland is one of the newer states that had it passed a law that's effective in 2021. Maryland, which is a close state to Virginia, very similar. You pass through the tax as a credit that was paid at the entity level. The individual shareholder or owner still needs to file a Maryland non-resident return and claims the credit. So Virginia side CPAs asked Virginia to do a ruling so that we could verify that they would get the credit on your Virginia return for the taxes paid at the entity level. Also, things to consider if you're claiming these credits on your resident return for taxes paid to other states, what attachments are going to be needed. Virginia does not allow the K-1, so you still would have to file an out-of-state non-resident return and attach that to the Virginia return, granting that Virginia will allow these credits. We really think they should. It kind of meets as, looks like a tax paid, even though it's paid at the entity level. It should be able to qualify, but we don't have any definite verification from Virginia yet. And the other thing that you want to consider is if you're paying withholding, non-resident withholding, if you're making estimated tax payments in 2021 and 2022, if you're going to make that election, how are you going to transition to the new entity level tax? Can you just call the state and get the withholding applied to the entity level? A lot of states will have different accounts for the different taxes. So they'll have an entity account, they'll have a non-resident withholding account. And when you make those payments, they go and those payments get credited to those different buckets. And you have to contact the state to try and figure out if you can move them. If you're trying to change where you've been making non-resident withholding payments and you want to change it to a pass-through entity tax, there could be some, I wouldn't say issues, but you need to basically consider that, when you're making this change. Yes, I got two questions.
Is Virginia looking at this at all? That's one question.
As a pass-through entity level tax?
Yeah.
I haven't seen any guidance. Have you seen any guidance on it?
As far as implementing,
Implementing a pass-through entity level tax.
I don't think so.
Require legislative change.
Yes.
So I just wonder if
We haven't
it's on
seen
their
anything
radar screen, yeah.
proposed. They were talking about combined entities, but that's for C corps.
Virginia is slow to make changes.
Yeah, they're still the only one on cost, one of the only ones on cost performance.
So
too,
Virginia is slow to make
well-
changes. So I think that's might be a little ways down the road, but not to say that it might not happen under the new administration.
Yeah.
I've talked to the new governor.
That's right.
Vince, did you have any?
That was the question.
That was the question.
Okay. Okay.
Terry, I'm going to hand it over to you and
Okay.
you've got the floor.
Yeah, now we're talking about selling taxable services. Earlier, I mentioned, with the whole Wayfair and economic nexus for sales tax purposes, what about, what are taxable services and what are potential tax filing requirements in other states? Because again, most states tax some services. Virginia doesn't tax very many services, so you can't make the assumption that because I'm a Virginia-based company and I'm selling services to customers or clients in other states, and those services aren't taxable. Those other states do in fact tax a lot of services. 22 states currently tax software as a service. This is a popular area where, it used to be that the software, canned software, you went to the store, you got the CDs, or even before that, you got it on tape. So you had a physical product that you would load onto your computer and to get the software. Well, these days, those tangible mediums are gone. So it's all electronic. So if it's, you download it, that's software still, but if you don't download it, but you access it, is that still software? And some states will say, well, software, regardless of how you characterize it, is taxable. Virginia, on the other hand, says if you have it in tangible format, if you got it on a CD or tape or some other tangible format, then it's taxable. But if you download it or you access it, as in software as a service, it's not taxable. But again, other states do tax it. And this is potentially problematic because a number of states tax software as a service. They also might tax digital products. And you say, what's a digital product? Well, lots of things could be a digital product. It could be anything from music or videos or books that you might download. It could also be considered something like on-demand webinars that you might be using for your CPE purposes. Are they potentially taxable? So again, not taxable here, but a number of states do tax it. So to the extent that you are providing these digital or software services in other states, they might be taxable and they might get you to those threshold levels, which will require you to collect the tax in the other states. I also want to point out that with Maryland was the first state to impose a tax on digital advertising. Now, this has been postponed, the effective date until 2022, but this tax is currently under litigation. I fully expect it to go to the Supreme Court, because people are saying it's digital advertising. How can you tax it? That's contrary to the Internet Tax Freedom Act. That's just contrary to, you just can't do it. So we'll see how that plays out, but I think a number of states have considered taxing digital advertising because, you go and you log into your computer. You get all sorts of digital advertising, and why not tax it? Everything, tangible goods are taxable these days, why not electronic goods or whatever you want to call it? But the question is, something you need to think about is, does software that you're providing constitute SaaS, software as a service? Some states haven't technically defined software as a service. So is it downloaded? Do you have to have a license? What are the specific requirements? Does it constitute a digital product? Again, some states have defined software as a digital product. Some states haven't. So you need to, if you are providing potentially services that include some sort of software, SaaS, digital product aspect to clients in other states, you need to think about, what are you providing? We've had some clients say, I'm just providing services. I provide real estate management services and they're not taxable. Well, real estate management services might not be taxable, but to the extent that you are using software as a service to provide those services, some states might say that they are taxable. So you have to look at the underlying transaction and determine, is it taxable in those specific states? I wanted to point out, Maryland recently enacted a tax not only on digital advertising services, but also on digital products. And this is kind of a laundry list of everything they're taxing, which is a lot of things. It covers software, covers ringtones, newspapers, any type of subscription services to online information. So be aware of what you're doing. That's the point of this. Be aware of what you're doing. Think about, it's not only Virginia anymore. It's, to the extent you have customers in other states, you need to be thinking about those specific states' rules with regard to sales tax as well as income tax.
Okay, back to me. So this is market-based sourcing of revenue for services, and it could also apply to, you know, software as a service, IP, intangible products, or intangible property, licensing of software, licensing of trademarks. So you historically, back many years ago, a lot of states were on the cost of performance. And as we mentioned, Virginia is still on a cost of performance state. They have not moved to a market state, but many states have over the years. In fact, 33 now, I think we're up to. And historically, as I said, when you sold service, it was sourced where the actual service was performed. And moving to a market-based sourcing, now if a state is a market-based sourcing state, you're going to be looking at where the customer is. Where is the service being delivered? Where the customer receives the benefit of the services. And I had a CPE event, or I was online at a CPE event for state and local specialty, because I take those every year, obviously. And they were talking about, one of the polling questions was, do we think it's going to be harder to administer market-based sourcing versus, cost of performance for sourcing? And a lot of the participants said that it's going to be harder to do market-based. And I tend to agree if you think about it more, because there's such a variety and it's very vague about where the customer is going to be receiving the benefit and who is the ultimate customer. So there's a lot of things to consider when you're looking at market-based sourcing. What is the service? And we're going to talk a little bit about that, about a couple of cases in a few minutes. But you need to be watching, these states that have moved to it. Another trend is states have been moving to single sales factor, which is actually making the sourcing of sales much more important than in the past, because it's just the sales factor when you're looking at apportioning income for trader business. So as I said, generally it's going to be sourced to where the customer is. Again, who is the customer? You look through the actual seller. For example, you look through to the ultimate customer. If your customer is somebody who's developing an app, but once they start using the app and once it's developed, is the licensing of it, whoever is using the app. So do you look through your customer to who is actually using the app? Sometimes you're going to know this, sometimes you're going to not. I think the recommendation right now is to try and get that information if at all possible. The other question is, what is the service? There was a case in Texas. Yes, we all love Texas. A Sirius XM case, Sirius XM radio. You guys probably all know about it. Comes on new cars. You get a free subscription for I don't know how many months. Well, Texas came in and audited Sirius XM, and Texas said the service that's actually being performed is the decoding of the actual radio that you're listening, that the actual subscriber is listening to. And Sirius XM said, no, the service is the actual production of the content that's being, streamed over the radio, which all the production was outside of Texas. Texas was a cost of performance state at the time. They recently changed their laws in early 2021. But they're aggressively going after and trying to say, no, the actual service was actually being performed where the provider, not where the provider is, but where the subscriber was when they descrambled the code. And that's what the service that you guys are providing, the descrambling of the code. So that's happening actually in Texas. So we need to apportion your sales to Texas. And the lower courts agreed with Texas. And I just read that in September 2021, the Supreme Court, Texas Supreme Court, has agreed to hear that case. So this issue is not dead yet, but so you can see that it can be, kind of an issue as to what is the service and how do you actually, apportion it. Here's our code number 7. Code 7 the number is 146. So make sure you are putting that in the top corner of your where you need to enter it. So, market-based sourcing is, I think, it's definitely here to stay. More states are moving to it. As I said, Texas just changed their law, and they are aggressively trying to say that they're trying to say that it's mostly market-based sourcing, or they're trying to be creative and saying that the actual performance of it is in Texas. Because they want to fairly allocate those strictly online services that are being performed, and they want to make sure Texas is getting their piece of the pie, because the economics of where everything is coming from is in Texas. Florida also has a cost of performance on the books, but has had technical advisories saying that they are going to a market-based sourcing. So you definitely want to make sure you're looking at the fine print, because this is an item, especially in states where it's only single sales factor when you're apportioning income.
Yeah, so the key is pay attention to the specific states. Again, you can't assume other states are like Virginia. You need to look into the details as far as the individual states. But talking a little bit about lingering COVID and telecommuting tax requirements. I mean, everybody likes working from home. This guy's out in his yard, just working, and maybe he's working, maybe he's not. I don't know. But anyway, we hope he would be working. But anyway, as far as out-of-state telecommuting and state income tax withholding requirements in Nexus, state income tax withholding is typically, the wages are taxable where the employees are performing the services. So if an employee is performing services in Virginia, withholding is required in Virginia. If they're providing those services in North Carolina, the withholding is in North Carolina. So if you have a Virginia resident who's been hanging out at their Outer Banks rental or vacation home, all these, during COVID, they have North Carolina withholding requirements. So again, it's some exceptions to the general rule as to where the services are performed are, de minimis rules. If somebody's temporarily in the state, state might not require withholding, or there could be reciprocal agreements between states. For example, Virginia has reciprocal agreements with Maryland, Pennsylvania, sort of with DC, West Virginia, Kentucky. So, to the extent that the states have reciprocal agreements that, Virginia doesn't require withholding, when it's a Maryland resident. Virginia will say, okay, that Maryland should be reporting Maryland tax. And then the other issues, potentially the state has no income tax. A number of states don't have an income tax. So things to be thinking about, to the extent that you have employees who are teleworking, whether it's temporary still, or whether it's going to a permanent basis, because a lot of people are thinking, hey, this telework is working, or maybe it's not. But, think about, what are the potential requirements? Withholding is one. And we've always had these issues. Actually, whether or not we want to recognize it or not, to the extent you have employees who are traveling for business, salespeople or CPAs might be on a project in another state for a couple of months, or attorneys, so we've potentially had these requirements, for a long time, but it's only because of the whole COVID situation that it's come to the forefront. Some other issues to think about, with sales tax, if you have an employee in a state, that creates nexus, unless the state has come out and said, well, due to COVID, that's not going to be an issue. But generally speaking, physical presence does create sales tax collection requirements. Also, from an income tax perspective, unless that person is soliciting sales of tangible personal property only, then it might create a income or franchise tax requirement. With unemployment insurance, local taxes, some states have these local head taxes that might apply. So again, be aware of what's going on in these individual states. There could be pass-through entity non-resident withholding requirements because you've got people working in the states. Also, registration with the state, Department of State, State Corporation Commission, what have you. And also a potential impact is on your credits and incentives. Say if you are, you have a state income tax credit because you are hiring or employing a certain number of employees at your headquarters. And well, all of a sudden those employees are scattered all over. They're no longer located in your headquarters. Do you potentially lose out on the state credits or incentives? So it's something to potentially reach out to the state or localities and say, hey, because of COVID or because of COVID and future, future, I guess, work issues, we're going to a telecommuting process, then how is that going to affect your credits and incentives? Because it may. And so it's something to think about as you're formulating telecommuting policies going forward. Also think about non-filing penalties. If you haven't been filing in states or localities, what are those potential penalties that you might be subject to? And also audits. I mean, audits are potentially a given, and more so we're seeing now in the withholding tax environment.
Before we get on to year-end planning considerations, any other questions for right now? If you don't have any others. So year-end considerations. We're finishing up the last 5 minutes. Go through and if you have any questions after, you can certainly contact us. But think about where your current business footprint is. Where your physical presence. Do you have telecommuting employees that may be causing nexus in other states? Are you one of the states that may have subjective economic nexus rules where it could be vague on if you're have a filing requirement or not? Consider your future plans. Are you planning on selling the business? You have, venture capitalists coming in and putting in some major equity. If so, you want to make sure you're filing in the proper states. If you do have any gaps in compliance or opportunities, making sure you're trying to, minimize the risk and the gaps. If there are major gaps, then you could look at doing a voluntary disclosure or even an amnesty. Connecticut is currently having an amnesty program. So, you want to make sure you're taking advantage of those. If you do have any gaps in your compliance, make sure you're being proactive on what your future plans are. It's better to plan to collect sales tax if it's required, as opposed to facing an audit and non-filing penalties when you're being reactive. So making sure you're definitely on board with trying to be proactive on that. It's going to cost you less in the long run. We do have some clients every once in a while who are like, let that state find me, I'm in there very little. So, I don't know if we recommend that if it's material. So, definitely want to be watching where you're doing business and where your customers are, especially in light of market-based sourcing. You want to make sure, at least in Virginia, you're looking at your B-poll, making sure if you are multi-state, there are possibly some opportunities to reduce your B-poll and your gross receipts by apportioning states or sales to other states if you're filing income tax returns there. So there's possibilities there. Make sure you're doing unclaimed property filings. Everybody seems to forget that. And if you don't file an unclaimed property return, the statute of limitations never run. So Virginia is can be one of those states that's aggressively pursuing unclaimed property. And speaking of other audits, use tax. I know with Wayfair and the marketplace rules, a lot more online businesses are charging sales tax, but you definitely, if you're in a business and supposedly for individual purposes also, you should be reassessing or assessing use tax if you're not charged sales tax if you buy something from an out-of-state vendor.
Yeah, and let me chime in on that too. We're seeing a number of clients being audited by Virginia for sales and use tax purposes. And most of the exposure is on the use tax side. It's because clients, for whatever reason, have not been actively monitoring their use tax requirements. It might be because years ago they gave a vendor an exemption certificate, but that's no longer applicable to them. So the vendor might not be charging them sales tax, so they should be self-reporting use tax. So it's a big issue these days. Still, I mean, as Kay mentioned, a lot of online sellers are now collecting Virginia tax, so it's not so much an issue there. But still, it's an area where you need to actively monitor your compliance, because at the end of the day, one day Virginia's going to audit and they're going to potentially assess you a large amount of money. and there's not but so much you can do about it.
And then the last item, as far as your considerations, conformity. So Vince had talked a lot about new tax law, the Build Back Better Act, federal law. So hopefully, if that does pass before the end of the year, Virginia will quickly, and I laugh because they don't do anything quickly, I don't think. Hopefully, Virginia will conform to any type of federal legislation that does get passed. You know, as Vince alluded to, there are definitely some differences on past bills, the PPP loan for Virginia as well as any other states, and the 163J interest limitation. So definitely want to be watching for that. So if we don't have any other questions, here is our last code of the morning, code 841. Make sure you're putting that in your screen, in your upper corner. And if you do have any other questions, you know, our contact information is on the website as well as on the screen. Feel free to give us a call or email us if you have any questions about some of the items that we talked about this morning, sorry. And I hope you have a great day and happy Veterans Day. I meant to say this earlier, it is Veterans Day, and I want to thank everybody for their past service who may be listening in, joining us virtually or even in the office. Thank you very much for your service, and I hope you all have a wonderful, wonderful day.